A ratio is expressing one numerical quantity in terms of another numerical quantity. Therefore, a financial ratio is the representation of one financial number in terms of another financial number. Ratios standardize financial data in terms of mathematical relationships that are expressed as percentages, times, or days. It facilitates comparison and can be used to determine trends across companies and across time. Ratios are interrelated, and therefore an inefficient firm is likely to have poor profitability, and that is expected to lead to lower market valuation, that is lower share prices and other market multiples. Such firms are generally finding it hard to issue new shares to raise equity and therefore have to borrow debt at unfavorable terms that make them more risky, and therefore ultimately this contributes further to their poor profitability. In ratio analysis, the number alone is not important. A ratio in itself is not the answer, except if you are doing an exam and you are required to solve a ratio question. However, a ratio in itself is an indicator, and it requires the analyst to provide interpretation. The ratio may be an indicator of the firm's relative activity, that is efficiency, profitability, liquidity, or solvency. To interpret a ratio, the analyst must provide interpretation and evaluation, and both these require to provide comparison. In this case, company X profitability in this year is higher than company X profitability in last year, that is 15.3% this year versus 14.9% last year as measured in terms of net profit margin. Even interpretation and evaluation alone are not sufficient for ratio analysis. The financial analyst must address the question of why profitability has changed, increased or decreased. Changes in profitability may be due to changes in revenue, and changes in revenue may be driven by changes in the volume, price, or exchange rates that affect the product sold by the company. At the same time, the changes in profitability may be attributed to changes in expenses. Changes in specific categories of expenses related to a company's business activities may cause the company's profitability to change significantly. Here we have the profitability of company X compared to company Y, and the evaluation suggests that company X is more profitable than company Y, as company X profit margin is 15.3% compared to company Y's profit margin of 12%. Again, simple evaluation or comparison is not enough. The analysis should explain why company X is performing better than company Y in terms of profitability. When using financial analysis tools and techniques, you must remember that computation are not the same as analysis. So we have computations not equal to analysis as the guiding principle when we analyze financial statements and other data. For example, when analyzing the past performance of a company, the analysis should not focus just on what has happened, but should provide an explanation of why and has it enabled the company to achieve its strategy. The key question in this regard would include what are the key aspects of performance that are critical to successfully compete in the industry. How well the company has performed relative to its own past performance as well as the competitors. What explained the observed performance of the company for this period, and is the performance of the company reflecting its strategy. Also note that every ratio may not be relevant in every situation. Some ratios are relevant in certain companies and in others they are not. For example, inventory turnover or days inventory on hand are relevant ratios for a merchandising or manufacturing business. However, the same ratios are not relevant for companies that provide services or financial firms or internet companies such as Facebook. At the same time, some ratios are redundant, such as the same inventory turnover ratio and the days of inventory on hand ratio. They are exactly telling us the same thing. These two ratios are mathematically related, so if firm A has higher inventory turnover than firm B, it also means that firm A will have lower days of inventory on hand relative to firm B. So we don't need to calculate or present both these ratios in our analysis. Similarly, industry-specific ratios can be as important as general financial ratios. For example, in the hoteling industry, occupancy ratio, average daily rate, and RevPAR, that is revenue per available room, are some of the ratios that are quite important in addition to the conventional financial ratios. Occupancy ratio, for example, is equal to rooms sold divided by rooms available. Average daily rate is then equal to total room revenue divided by number of rooms sold. Different users and questions will focus on different ratios. For example, creditors will be particularly focusing on solvency ratios, including both leverage and coverage ratios. On the other hand, investors will focus on market ratios such as price to earning, price to book value, as well as they will be looking at all the other financial ratios, particularly profitability. In addition, different sources categorize some ratios differently and include different ratios. Sources may include textbooks and commercially available databases such as Thomson Reuters, Value Line, Yahoo, Morningstar, Zach Investment Research, etc. For some ratios, there is little difference. For example, the current ratio is probably universally defined as the current assets divided by current liabilities, and it is viewed as an indicator of the liquidity of the firm. For other ratios, differences in categorization exist. For example, the cash conversion cycle is categorized as a measure of liquidity but is also closely related to measures that are categorized as measures of efficiency. Differences in accounting standards across countries limit the comparability of financial ratios for different firms. So, companies that report under US GAAP and companies that report under IFRS may not be compared unless the financial data is adjusted and standardized. Financial ratios are here categorized into 5 groups. Activity ratios, which measure the efficiency of the firm's operation and the management of firm's assets. Liquidity ratios, which measure how well the company is positioned to meet its short-term maturing obligations. Solvency ratios, which measure how well the firm is positioned to meet long-term obligation. Profitability ratios that measure the return on investments to the firm. And finally, valuation ratios that measures the valuation of the firm with respect to different market multiples. First, we discuss the profitability ratios of a firm. Return on equity is the rate of return to the shareholders of the firm on their book value of equity. So it is not a market-based return, but an accounting rate of return on the shareholders' equity. It is calculated as the return on equity to the firm is equal to net income divided by average equity, and where average equity is calculated as the book value of equity at the beginning of the year plus the book value of equity at the end of the year divided by 2. Remember, the book value of equity at the beginning of the year is generally the book value of equity at the end of the last year. Keeping other things constant, the higher is ROE, the better it is. The return on equity can be decomposed into other ratios to identify the key drivers of the increase or decrease in profitability and hence the performance of the firm. For example, here we are decomposing the return on equity into 2 ratios. One is the return on asset and the other is the leverage ratio of the firm. This ratio is also known as financial leverage. Such decomposition of return on equity is useful because it helps us understand what are the drivers of the company's ROE. That is, what are the reasons that results in changes in ROE over time for a company, and to determine the reasons for differences in the ROE for different companies. It also helps in identifying areas where improvements can be made to increase ROE. It helps in breaking down ROE as a function of the efficiency, operating profitability, tax management, and use of financial leverage of the firm. The decomposition of ROE is also known as DuPont analysis, as this was developed by DuPont Company earlier. Here we have the two-factor decomposition of ROE. We have two ratios. One is return on asset and the other is leverage. Return on asset is a measure of firm's operating efficiency and profitability, while leverage here is a measure of the financial risk, which measures how many dollars of assets are supported by each dollar of equity. From our discussion in earlier topics, we know that the balance sheet is representing the business risk and the financial risk of the firm on the asset side and the liability side respectively. The asset structure on the balance sheet is representing the business strategy of the firm, while the financial structure is representing the financial strategy of the firm. This two-factor decomposition therefore suggests that if the firm increases its return on asset by improving its business strategy, it will increase ROE. Similarly, the financial strategy of the firm, as is reflected by the financial structure of the firm, will have its influence on the ROE. So improvement in the financial leverage as represented by the financial structure will also improve return on equity. As long as the company is able to borrow at a rate lower than the marginal rate it can earn investing the borrowed money in its business, the company is making an effective use of leverage, and the ROE would increase as leverage increases. If a company's borrowing cost exceeds the marginal rate it can earn on investing in the business, the ROE would decline as leverage increased, because the effect of borrowing would be to depress ROA. The return on asset is the rate of return the company earns on its assets during the year. There are two formulas for the calculation of the return on asset. The first one is net income divided by average assets, and the second one is net income adjusted for interest divided by average assets. That is net income plus interest expenses into 1 minus the tax rate divided by average assets. This is also known as basic earning power. There is another version of the basic earning power formula, which is calculated as earning before interest and taxes divided by average assets. The most common formula used for the calculation of return on asset is the first one, which is net income divided by average assets. However, the second alternative is also used, which is adjusted for interest expenses after adjusting for taxes. The numerator is the amount of earnings applicable to both equity holders and creditors, and it is consistent with assets being financed by both equity holders and creditors. For the DuPont analysis, we always use the return on asset given here in the first formula. A company can increase its return on asset in two basic ways. First, by increasing operating profitability, that is the operating profit margin. Second, by increasing asset turnover, that is better utilization of assets, that is generating more sales per dollar invested in assets. In other words, we mean improving efficiency. So return on asset can be increased by improving profitability and improving efficiency. Now, these two factors are dependent upon the competition in the industry in which the firm is operating and the business strategy that the company has adopted. We can now see that the ROE of the firm can be decomposed into profit margin, turnover, and leverage. That is profitability of the firm, efficiency of the firm, and risk, or in other words, financial leverage of the firm. So the return on equity is driven by the profitability of the firm, its efficiency, and the risk it is taking to earn that profit and achieve that level of efficiency. In other words, these first two ratios here represents the business risk of the firm, and this one is representing the financial risk of the firm. We can then derive the ROE as dividing this revenue with this and this average assets with this to get net income divided by average equity. In this mini case, we are required to decompose the return on equity for three companies, that is company A, company B and company C, and identify the driver of the return of equity for each company. Note that the average equity for all the three companies is the same. However, company A has total assets of 1000, company B has total assets of 2000 and company C has total assets of 1500. So in other words, this company is 100% financed by equity. This one is 50% financed by equity and 50% financed by debt, and this company has 67% financing by equity and 33% financing by debt. Also note that the three companies have the same net income, that is $200. However, company A has the lowest sales volume while company C has the highest sales volume. Given that net income and average equity is the same for all the three companies, we see that the return on equity is 20% in each case. The net profit margin is however the highest for company A, where $200 divided by $2,000 in sales is equal to 10% net profit margin. For company B, it is $200 divided by $4,000 in sales and it is 5%, while for company C, it is the lowest, which is $200 divided by $6,675, that is 3%. We see that company A has the highest profitability while company C has the lowest profitability. If we look at the total turnover ratio for each company, company A has $2,000 in sale and $1,000 in assets, so its asset turnover ratio will be $2,000 divided by $1,000, that is 2. The same is the case for company B, where $4,000 in sales are divided by $2,000 in average assets, that gives us turnover ratio of 2. For company C, the turnover ratio is $6,675 in sales divided by the average assets, which is $1,500. So that gives us the average turnover of 4.45. The leverage ratio is 1 for company A, as $1,000 divided by 1,000 is equal to 1, and here it is $2,000 divided by 1,000, so that is 2. And for company C, it is $1,500 divided by $1,000, so it gives us 1.5 as the financial leverage for company C. In case of company A, the main driver of return on equity is the net profit margin, which is 10% compared to 4.7% average for the three firms. In the case of company B, the main driver of return on equity is leverage, which is 2 times compared to 1.5 times average for the three firms. For company C, the main driver is the turnover, which is 4.45 times compared to the average of 2.82 times for the three firms. Here we have the ROE decomposed for three actual companies, that is Apple, HP and Dell. For the year 2008, we can see that Dell has relatively low profitability. However, it has a higher return on equity, mainly because of its turnover ratio of 2.26, which is higher than the other two firms, as well as its financial leverage, which is 6.67 times, significantly higher than the other two firms. For Apple, the net profit margin is much higher and reflects a strategy of competing on product features rather than price, and its asset turnover is lower, that reflects a strategy of having own retail stores, that is Apple stores. Also, though not shown here, Apple's lower turnover reflects its retail strategy, which requires increased investment in property, plant and equipment. The significant amount of cash on its balance sheet, which generates non-operating income, does not generate revenue, and subscription accounting for iPhones create deferred tax assets. These factors may help explain the lower asset turnover for Apple. That is, net income divided by revenue is equal to EBIT divided by revenue multiplied into EBT divided by EBIT multiplied into earning after taxes or net income divided by EBT. This represents the operating profit margin of the company. This represents how much of the operating profit are consumed by interest expenses, so it is the interest burden, and this represents how much of the earning before taxes are consumed by taxes, so this is the tax burden. In other words, the tax burden reflects the percentage of pre-tax profits the company keeps as net income after deducting the tax expense. On the other hand, the interest burden reflects the percentage of pre-interest and tax profits the company keeps as pre-tax profit after deducting the interest expenses. A higher value for the tax burden means that the company can keep a higher percentage of its pre-tax profits, indicating a lower tax rate. Also note that some analysts prefer to use operating income instead of EBIT for the second and third terms in this equation. In such a case, the second term would capture both the effect of interest expense and non-operating income on the return on equity. There are some profitability ratios that can be directly observed from the common size income statement. These are also called income statement ratios because both the numerator and denominator are from income statement. These include gross profit margin, operating profit margin, and net profit margin that we discussed when we analyzed the income statement in week 4.